We are now in model number 3, and thank you for joining us here once again. In this setting, I want us to position our minds so that we can examine option components. Yes, you heard that correctly. Option components. And not only just the components, but also the mechanism by which they operate. So, in our realm, we'll consider this to be decoding the option chain, understanding what drives value, and how to interpret market signals. So, at the end of this session, I want us to have a grasp and be able to read, to interpret the option chain. I want us to understand and differentiate between the intrinsic value and the extrinsic value. So intrinsic inside, extrinsic outside value. All right, so this is in relation to the option. Then I want you to bear in mind what we will consider to be the bid, ask, spread, and volume. Not only that, the open interest and understanding what they mean and how they affect the trade as a whole. Because if we are in a trade and the trade is not moving in our direction, then we are at a disadvantage. So we have to be very mindful of that. And we're going to get into some real world application, and we're going to use some real world examples such as SOFI and APLD to apply these mechanisms so as you can see exactly what is taking place. And as you know, we are biblical people. So we focus our principles based on the Bible so that we have some biblical clarity, so that we can utilize the Bible in a meaningful way in our everyday life. So the principles we'll be engaging in will give us a clarity. It will allow us to be vigilant. It will give us wisdom in our decision making as we engage in this simple but complex instrument. So now, let us get into the meat of the matter of the meat that you came here to devour. Let us go into our mind's eye and think to yourself, what could be an option chain? Well, an option chain or option matrix is effectively the menu board. So you go into a restaurant and they have lamb chops, lamb splits, lamb slices, all these kind of lambs, all right? So this is basically the menu board of available option for a given underlying stock. It lists all the different contracts by their expiration date. We also have the strike price. We also have the call or the put, and it shows key metrics like the premium, the ask bid, the volume, and the open interest. Yes, the open interest is important when it comes on to options. So key columns you'll typically see, as we had alluded to in our last sitting, were the expiration date. Let me initiate a recording sequence so that you can see exactly what I am seeing in this moment of our conversation. All right, so we're going to engage in a recording sequence. Now that the recording sequence has been activated, let us get into an actual option chain. So the first thing we want to do is to click on one of our accounts, and the accounts that we're going to click on is the Webull account. In this section of our discourse, then we're going to go into the market, and then we're going to search for, let's say, SoFi, because you know SoFi is one of our favorite companies in 2025. Now, we are seeing the trade and the option section. Let us click on the option section, and it brings up the option menu. And with this menu, we can see first of all, we can see the option dates, the date when they will expire. In the center, it tells us the days that are left on these various positions, and we can select whether we want to see calls or put or both, but we tend to want to see both so we can make a logical and rational decision in determining if it is favorable. So let us get into it. So we see the expiration dates along the left side, and depend on what platform you're using, it may be a little bit different, but we're teaching from the Webull and the Moomooo apps. All right, so now it is about 6:23 a.m. The market will open by 6:30. So based on that idea, some of the values in the call and ask and bid section have been cleared out. So all of yesterday that has not been filled or that has been filled have been cleared out. So we're starting basically afresh today. So this is where we are and what we have to look at. So now we have in the center where we have the number of days left, we can see the prices in dollar figures, and that there would be the strike price that we are expecting the particular option to reach. All right, and then on your right hand side, let me just put it up so we can see it by itself, that there would be our put section. So these are saying that the market needs to go down. I think the market is going to go down. All right, if you're buying. The call section indicates that the market is going to go up. All right, and you just see that the price, the strike price, is on the other side. So now when you select one, let's enter our password, it shows you the list price or the limit price. All right, and it shows you the ask and bid that is cleared out at this time. But once the market gets open, then we will see what the prices are. But the limit price is the price that it had in the last sitting. All right, so that is what it is saying right at this moment. So changes from the previous day, the volume, the contract traded today would be indicated by the volume. All right, so we have different things. So volume is 0. If we look, it's saying volume is 0. That is because nothing has been traded in this moment. Then we move into the open interest. So sometimes people have put on position waiting for them to be filled whenever the price reaches their strike or their cost basis or the premium that they want to pay. So when that happens, if you already set that up in your system, then you will have a state in which there is an open interest, there's a desire to buy at a particular price when it can be agreed upon. So that there is the open interest, the contracts which are outstanding. Now, we have something called IV, which is possible implied volatility. And then we have the Greeks. All right, so let us see if we can put a back both so we can see the big picture. And then we have open interest. And as we scroll to the right or the left, everything scrolls in the same manner. All right, so implied impl dot vol is the same thing as implied volatility. Then we have the Greeks, we have the delta, the theta, the gamma, and we have quite a few, but those we'll get into at another junction. So these are just some things that I want you to bear in mind as we examine the market sentiments. And in understanding what is happening, we are better positioned to plan for the future. So let us give an example using SoFi or APLD. So for SoFi, let's hypothetically say SoFi, you can view its option chain on Webull, which we just did, And we can also go to, let's go into Moomooo. Let's go into Moomooo. So click on Moomooo, and we're now into Moomooo, and we're going to go into the watch list. We're going to look for SoFi, and if it's not there, if you haven't created your watch list just yet, what you can do is just in the search bar type in the particular stock, SOFI, and it comes up. And in the same manner as the last platform, the Webull platform, it shows you what is taking place. You have the trade and the option. You click on the option and the chain comes up in a similar manner. So we have single option. So you can choose a strategy or a combination thereof. All right. And the calls and the puts are similar. The strike prices are the same. So you just have to know how to read the different chains. And it tells you times 100, indicating that there are 100 of the stock in the contract. So this is the option chain. And let us just go quickly and search APLD and see what it is doing at this time. APL APLD. All right, so apply digital. So this is currently trading at $34.42, or let's say $33. So we have an idea as to what is taking place, and we are already in the option chain. All right. So if you want to engage in any of these practices, feel free to utilize the links in the description below so that you can get access to these platforms. And the reason I'm recommending them is because for a new person, they are fee free. All right, you have to pay a small fee towards the institution which regulate the regulatory body, SEC. But other than that, the platform itself does not charge you any fees like the legacy brokerage. All right. So this here is more geared towards younger persons, persons who don't have a lot of capital, and persons who actually want to move ahead using strategies, can take more risk, can try more times, can fail more often, so that they can learn and put themselves in a financial position of abundance. So these are just some things that I want you to bear in mind so that you can appreciate the concept of option market, the option mechanism, the option structure. All right. Now, let us get into the Word of God. It says in 1 Corinthians 14, verse 40, let all things be done decently and in order. So, reading an option chain properly is a matter of order, structure, and discipline. So we have to position ourselves to do that which is right, do that which is righteous, and make sure that we are taking the best and most advantageous positions that we can take under the circumstances of the knowledge that we currently have. Now, let us get into the conversation of the intrinsic value versus the extrinsic value. So when you look at the option chain and at the option premium, the price that you pay, it composes of two parts, right? So it has the intrinsic value, and the intrinsic value, basically, this is the part of the option premium that is in the money, the amount by which exercising would be profitable immediately. So, we talk about in the money, we talk about out of the money in the last sitting. All right. So, if it is in the money, then the intrinsic value means that this is the value that it have if you actually exercise at this juncture. So if you buy a option contract, let's say you look at SoFi and it is trading at about $30 and you have a call with a strike price of $5, then the intrinsic value would be 30 minus 5, which would equal to $5. And you have one contract which comprise of 100 shares counts. So you're gonna type 5 by 100 and then you will have $500. So it's that simple for us to understand. But let us look at it now. If you pick a contract, an option that is out of the money, which means that the price has not yet been reached, so the strike price is above the current price, the intrinsic value is 0. So if you execute it now, you'll be basically giving away money, buying something more expensive than it actually is. Now, that value is important when you have positioned yourself appropriately, and you want your options to expire in the money if you want to be assigned. But if they expire out of the money, guess what's going to happen? You are not going to be making any money on that option. Now, let us get into the extrinsic value. So when we talk about the extrinsic value, this is the portion of the premium above the intrinsic value, which accounts for the time to expiration. It accounts for volatility in the market, interest rates, and other factors. Also, it is called sometimes time value. All right. Let us use a hypothetical situation again. So, for example, suppose the SoFi call with 35, well, 25 in the money sells for $7. The intrinsic was 5. The extrinsic would be 2. That would reflect the time value and velocity, right? So the reason we get the intrinsic to be 5 is because we have it at going for $30, correct? And it's at 25. So the value that it has is that $5. Good. And the extrinsic, accounting for velocity and all the movements in the market, is the additional $2. So that is how we got the $7. If you had an out of the money option, example, let's say SoFi strike at 35, the underlying intrinsic is 30. Which means that zero premium might be possible because intrinsic is 0 because it didn't reach its strike price. So all the premium that you'll be paying would be extrinsic. It's better you pay for one item once than paying 2 times for the same item. What am I saying? I am saying that sometimes it's better to pay for the extrinsic value than the intrinsic and extrinsic value if you are waiting out in the future. If you are going to do a quick play, then it is more favorable for you to buy the intrinsic and the extrinsic value. So the further out in time you are going to go, then the best option is to select an option that is out of the money. If you are closer to your expiration, then we're going to go in the money. All right. So that there's just an idea. So let's say APLD is at $34.35. A call at a strike of $30 is in the money. by $4.35. If the premium is $5.50, then the extrinsic value would be $5.50 minus the intrinsic value, which is $4.35, which would be $1.15. A call with a strike price of 40 is out of the money because the price is now at 34.35. So if the premium is $1, then the intrinsic value is 0, but the extrinsic value is $1. So that there is just something that you can bear in mind when we talk about the intrinsic and the extrinsic value. So intrinsic value is a value that you have right now. The extrinsic value is a value that is given to you from the outside, and those two go together to determine the fluctuation in an option price. So most times if the option moves favorable, both the intrinsic and extrinsic increase. But when it moves unfavorable, the intrinsic decrease and also the extrinsic decreases in a likened manner.